Thanks, Jim. Okay, thank you very much for that panel discussion. We're now moving on. I'd like to invite to the platform Adam Kent, Managing Director, Maritime Strategies International, MSI, Demand, Deliveries, Decarbonisation, Deviation, Disruption, 5 Ds. Adam, please. And I'll bring you
Good morning, everyone. Thank you, Kevin. As Kevin has said, I'm going to cover the 5 Ds. As ever, there's a lot to get through, so I will be going at quite a pace. I'll be around all day if anyone has any questions. To get things off, I thought I would get it out of the way and put this slide first. I know some of you do look forward to this slide, and for anyone that hasn't seen this slide, what it's there to do, it just show basically where each sector is on the earnings cycle and the relative positions one sector versus another. It doesn't allude to any timings, it's just purely where are we on the earnings cycle. On the left-hand side of the chart, we can certainly see the oil tankers, the car carriers, the ro-ros that we've just heard a little bit in the last panel. Fundamentals remain strong here. What I would say is some of the froth has come off the top of these markets, but they are still performing very well from an earnings perspective. Moving sort of down towards the middle of the slide, what we can see here are the bulkers and containers. We've seen quite a bit of softening of fundamentals over the course of the last 12 months. We do expect to see the bottom hit this year, and it won't necessarily rocket thereon after, but we will start to see some improvements in 2025. On the right-hand side, we can see offshore. Now, offshore has gone through a very positive last 12 months, and we do expect to see some further improvements over the course of 2024. And at the top of the pile, we've got LPG. LPG has benefited both from propane imports into China to feed PDH plants, but also some of the inefficiencies that have been brought in by the Panama Canal, and I'll talk a little bit about that in a later slide. So to drill down on a bit more information on the demand side, the first of the Ds, I thought I would just put up an overview across sectors, comparing and contrasting demand for a range of shipping sectors, both in 2022, 23, 24, and also the last 10 years average. And what we can see here is that 2023, apart from containers, we saw positive cargo growth across the board. And in many instances, this was at or above the historical 10-year average. You'll see that 2024, we were also expecting to see positive growth actually now across the board, including containers. And so in summary, I guess the message from this slide is 2024, we're not going to really have a problem on the demand side of the equation. If we drill into some of the sectors specifically, I thought I'd start off with dry bulk. The chart on the left and the chart on the left for the next few slides just shows incremental growth by commodity group in or trade lane. And we can see for dry bulk, 2023, we saw a huge ramp up in coal being shipped globally. Now, a lot of this coal was being shipped to China. One of the reasons it was being shipped to China, we can see on the top right-hand chart. Fundamentally, China was suffering from droughts. There was a lack of electricity production through hydro, and thermal coal was imported into China to sort of keep the lights on, so to speak. We can see that at the back end of this year, the rains came, hydro was once more coal was once more displaced by hydro. So we can't see that sort of development going on, and we don't expect to see another drought in the same conditions in 2024. On the coal story, coming back to sort of the energy transition, you can see on the bottom right how we expect to see coal cargoes and the imports of coal to various parts of the world developing. China, we do expect to see coal imports decrease in the longer term, but some of that will be replaced by coal going into the likes of India and Southeast Asia. This year, from an incremental demand perspective, we can see back on the chart on the left, it's more of a balanced mix. We expect to see growth across all of the 4 dry bulk commodity groupings. On the oil side, 2023 incremental growth was very much driven by products and products trade. One of the reasons we saw incremental growth in 2023 was China coming out of lockdown. As we can see on the top right-hand chart, we've got regional oil demand growth, and China pretty much on its own helped drive incremental demand growth in 2023. We can see in 2024, however, demand growth or oil consumption growth in China will drop, and it'll be on a par with South Asia, predominantly India. And again, we have to look towards India to see incremental growth once we get beyond 2024, and it is not just a China story. Of course, the other thing that dictates shipping demand from a tanker's perspective are the locations of refineries, the crude that goes to the refineries and the products that come out. And we're continuing to see this development and more refinery capacity move east and to Africa, as we can see from the chart on in the bottom right, and retractions and reductions in capacity in the sort of typical OECD regions. Moving on to containers, 2023 witnessed the third of the last 4 years where we saw actually negative container incremental trade. That was sort of brought down by the main lane trades, but also intra-regional trades. So a poor year last year and the year before for container trades. We do expect to see an improvement this year, and we already started seeing an improvement at the back end of 2023, as we can see in the chart on the top right. One interesting development that we are starting to see is the development of more niche trades, more volumes going on niche trades. Some of this may be associated with sort of friendly shoring or near shoring. And the chart on the bottom right just shows you Chinese containerized exports to Mexico. We can see that we've seen some very strong growth rates over the course of the last few years on this route. This is fundamentally goods being imported to Mexico, being constructed and then exported to North America, either by road, by rail, or by ship. So some new trades developing and some larger volumes. Gas has been a very interesting sector over the course of the last 12 months or so. On the left-hand side, we can see LNG, very much dictated in 2022 by events in Ukraine, the Russian invasion of Ukraine, and Europe sort of demanding or trying to sort of buy LNG from anywhere it can. And we can see the big spike we saw in 2022. We've not seen that in 2023. And China didn't really come in and take the volumes that we necessarily thought that they would do in 2023. 2024, we expect to see further incremental growth. On the right-hand side, we've got LPG. LPG last year was very much dictated to, as I alluded to earlier, the PDH plants, the propane dehydrogenation plants in China, importing propane, and very much all the growth last year on the LPG with China. This year, we expect to see another strong year for LPG. So moving on to the second D, deliveries. Now, how you view deliveries or the fleet or the order book will very much be dictated to by what sector you put under the microscope. The chart on the left just shows you the order book in relation to the size of the respective fleets. Car carriers, container ships, LNG, LPG carriers. From this chart, you can see that the order book does appear still relatively or very large in the case of LNG sector. For crude tankers, products, dry bulk, ro-ros, the order book remains very low, in low single-digit territory in many instances. The one thing we've not seen a lot of in the last 12 months or so is scrapping, and that's meant that the fleet has continued to age. We can see on the chart on the right that the average age of the fleet is actually around 15 years old. Even for the tankers, where obviously a lot of the sort of oil majors refuse to charter vessels over 15 years old. We can see that we've got 13, 14 years old for a lot of the tankers. As we've heard, a lot of the older vessels are trading on the grey fleet, and that is helping keep that number high. Now, for anyone that needs to go and replace some of that old tonnage, there is a problem, especially if you want to get your vessel this side of 2027. The yards are, in effect, fully booked, you could argue up until 2027. This chart on the left just shows you shipyard output by contract year and delivery year, and I've also put 2023 delivery totals for comparison. Now, you don't need to do much maths to realise, well, actually, if we only see 60 million GT out of the shipyards in 2024 and 2025, and the rest becomes slippage, 2026 also looks pretty full if you sort of shift those numbers across. So trying to get a vessel, a large tanker, a large container ship, gas carrier this side of 2027 is a problem. China is dominating the order book. It now has over 50% of the global order book when measured in GT. The one thing I would say is that not all yards are actually busy once you start crunching the numbers. The chart in the bottom right just shows you the number of years since yards last took an order. And what we can see, there's a lot of tier 2 yards, and most of these will be in China, that haven't taken an order for a number of years. And what we have seen over the course of the last 18 months or so is around a dozen of these sort of mothballed yards come back online and sort of add to the shipyard capacity. So there is capacity waiting in the wings. We do expect to see some more of this coming online within the future as we start to see contracting pick up in the second half of the decade. I couldn't stand up here and do a presentation about anything really without mentioning decarbonisation in some shape or form, especially because the fact that obviously for shipping it impacts the cargoes, as we've heard earlier, but it also impacts the fuels that the ships burn. These are just 4 charts that I've taken from MSI's energy model that forecasts the sort of energy transition out to 2050. And the one thing I just wanted to say here is that we're sort of in a period now where we're going to see a transition. If you look at a lot of these charts, there's sort of an inflection point around 2025 when we started seeing a bigger take-up of renewables, we start seeing more efficiencies, we start seeing different trade developing. So we're in a sort of transition phase. And it's not all bad news for shipping. There are opportunities. We've been starting to be asked quite a lot about green steel. And if you look at our forecast on the left-hand side for HBI and DRI, the sort of fundamentals that go into green steel, we can see that that trade is set to go from next to nothing currently to around over 100 million tons by the middle of this century. So a big trade that will develop there. Another trade is also the shipping of green methanol and clean methanol and clean ammonia. There's nothing being shipped currently. By 2050, over 400 million tons of clean methanol, clean ammonia will need to be shipped. That will require, as we can see on the chart, around 250,000 deadweight tankers and around 400 VLGCs, or very large ammonia carriers. So a huge opportunity there for the shipping markets. Shipping, of course, is dealing with its own problems when it comes to fuel, and we did see continued ordering of dual-fuel vessels last year, as we can see in the top left. Around 45% of all orders from a GT perspective were for dual-fuel engine vessels. The picture's not as rosy if you look at things by numbers of vessels, and you only got about 20% of vessels being ordered with dual-fuel technologies if you look at numbers of vessels, and that is because typically the dual-fuel vessels are being deployed in the larger vessels, the large container ships, bulkers, et cetera, and we've still not seen that sort of big take-up for sort of the tramp shippers, whether that be in dry bulk or containers. We've not really seen that big take-up. But what we can see on the chart on the right is our view of how fuel demand will look going forward for shipping. It will become very much a methanol and an ammonia-driven industry. We do expect to see some oil still around being used as a fuel by 2050. And this is, of course, where things like carbon capture have to come in if shipping is going to meet its net zero by 2050. One thing that we are just keeping an eye on, I thought I'd just throw this in, is how the market and some of the regulations such as CII interact. This just shows you the month-on-month development of the Capesize fleet by CII. And I think it's going to be quite interesting when we start seeing strengths in the market, perhaps in Q4, how CII changes and how owners respond to the market, but also fuel price. Given that CII is being measured on a calendar year basis, that sort of back end of the year, we can start seeing some quite interesting developments, and that may in part help shape what goes on in those markets. Moving on to the last two Ds, deviation and disruption, which we've heard quite a bit about already today. The first one I just wanted to tackle was the Russian invasion of Ukraine. That has sort of reshaped the global trade map, and I think for certainly some cargoes, that's not going to go back, even if Russia pulled out of Ukraine. We can see the chart on the left, product exports out of Russia. Historically, before the invasion, the majority of those were going to Europe. Now we can see that they're going a lot further afield. And that's, of course, helping with the ton mile and helping keep the tanker markets as high as they are. If we focus in on Ukraine more specifically and look at the dry bulk cargoes that used to come out of Ukraine, certainly in the second half of the year, you'd expect to see around 10 million, on average, tons of dry bulk cargoes coming out of Ukraine. And we can see now that actually, you were lucky to see 2 million tons coming out of Ukraine, even with sort of the Black Sea grain corridor in effect. So some big changes have already happened, and I think they're here to stay. When it comes to the canals, the Panama Canal was front and center of everyone's thoughts, or a lot of people's thoughts, certainly sort of the second half of 2023, due to droughts within Central America and Panama more specifically. First, a limiting of the draft of vessels that could go through, and then a limiting of the actual number of vessels that could go through, and the new queuing system. Of course, if you don't go through the Panama Canal and you go either through the Suez or around the Cape, that's adding time, that's adding cost to those journeys. What it also did was make the fleet a lot more inefficient, especially for those vessels at the bottom of the sort of queuing ranking system, such as dry bulk, such as LPG. We can see the bottom left, the sort of number of days that vessels on average were having to wait to go through the canal. That went from around 2 days to sort of over 10 days by the end of last year. And we can see what it did to VLGC rates. VLGC rates sort of went from around $30,000 per day up to around 60 and above. Of course, everyone's now refocused their attentions on the Red Sea and the Suez Canal, and I think the sector that's probably been hardest hit has been the container ship sector. The chart on the left just shows you a breakdown of, on the container size spectrum, how many ships last year made one pass through the Suez Canal. We can see pretty much all of the big ships, over 16,500 TEU, went through the Suez Canal over the last 12 months. So this is going and is having an impact on the markets. And the chart on the right just tries to contextualize what could happen and what will happen if we see a continued avoidance of the Red Sea and the Suez Canal from the container perspective. From our sort of modeling and working out the vessel demand growth for the container ship, excluding what's the events in the Red Sea, we expect to see container demand growth for shipping go up by about 6% this year. If for the first half of the year we don't see any container ships go through the canal, this will rise to 11%. And then if we don't see any containers go through for the whole of the calendar 2024, container demand growth would go up to 16%. So a huge change in the container ship market, the longer the events in the Red Sea continue for. To put that into perspective, if you wanted also to keep weekly schedules, what you would need to be seeing is about 120 container ships operating on Asia-Europe. If they were to speed up by 1.5 knots, that would mean you'd need still 85 vessels to be trading Asia-Europe above and beyond what we're currently seeing. Of course, there is, as we've heard, a very large order book that could help solve that situation. The interesting thing also from an environmental perspective when it comes to rerouting is that, of course, rerouting by the Cape takes longer, you burn more fuel. So from an ETS perspective, if you have a vessel that was going, say, from Colombo to Barcelona, the ETS differential would be 75,000 euros. The somewhat paradoxical thing is from an individual's vessel's AER or CII perspective, you actually improve by going around the Cape. That's because your vessel is trading, spending more time at sea and spending less time in port. So from an AER or CII perspective, it's actually a better solution. So to wrap things up, I've just got 3 or 4 slides on earnings and values. Our forecast for earnings for this year and into 2025 remains relatively positive across most sectors of shipping, as we can see from the chart on the left, at or above the levels that we've seen on average during the 2020s, and in some cases significantly above those that we saw in the 2010s. New building prices, we do think will start softening at the back end of this year as deliveries outstrip new contracts, and we've not seen the inflationary pressures in terms of cost. It won't be a collapse, it will just be a softening before we start seeing a rebound in 2026. Values, asset values remain, I would say, very sticky and high. It's easy to see why tanker asset values are high, given where the market is and where we see perception of the market and sentiment over the course of the next 12 months or so. But just look at the Panamax bulker. I mean, the bulker sector hasn't been doing that well over the course of the last 12 months, but values are sort of at or sort of close to the top of the range that we've seen in the last 5 years. Now, I think there's a simple explanation for this. I think if you wanted a new vessel, many owners aren't prepared to pay the high prices, they're not prepared to wait so long. So what they're doing, and they're, of course, unsure about technology. So what they're doing is they're dipping into the S&P market and buying good, modern tonnage rather than ordering new vessels. That's keeping S&P volumes high and keeping the price high. When it comes to asset values in the future, we can see some distributions of asset values historically, where they stand today, and our forecast going out to Q1 2028. Generally, asset values will remain relatively high, higher than historical averages, and I think that's the take-home message from that slide. So finally, as I always try and do, is I'm not going to say I offer investment advice, but what I do is just run the sectors through the MSI models to see where, based on MSI's understanding and forecasts for earnings, forecasts for values, where are you best putting your money? So this exercise, what I've assumed, if you've got $30 million, burning a hole in your back pocket, it's a pure equity play, you're not leveraging, you're just going to put that 30 million on a horse, so to speak. What vessel could you buy? And what sorts of returns could you expect if you sold that vessel at the start of 2028? And I've color-coded them to help out a little. So green is offshore, yellow are the wet sectors, and dark blue are the dry sectors. You can see that offshore remains the top of the pile as it did this time last year. And otherwise, it's the tanker sectors and the gas sectors where you're going to get those double-digit returns. So thank you very much for listening. And if anyone has any questions, I'll be around all day. Thank you.